Hi, welcome to this week's market update and also our thoughts for the next financial year. As the current financial year draws to a close, looks like we're going to see a loss of around 8% for the ASX 200, which is quite disappointing following last year's 24% increase in the market. Most of the losses in the market have occurred over the last 2 months, as concerns around spiralling inflation across the globe have seen central banks lifting rates at quite a fast pace. As we start the new financial year tomorrow, we expect the next month or so we'll start to see inflation peak or even start to just slow a little. This should be good for markets as they'll start to gain some confidence that the reserve banks and central banks around the world will be able to take a more measured approach to lifting rates rather than the catch-up policy they've had over the last 2 or 3 months. While we could still see some short-term spikes in inflation caused by energy prices, mainly due to the Russia-Ukraine conflict, we do start to feel that the market is now better equipped to deal with these surprise events. The other major event that we're following is China's reopening following its recent COVID lockdown and statements from the Chinese government about reigniting their industrial production. As China reopens industrial production, our local markets should benefit in 2 ways. So firstly, as production increases, this should help ease supply chains, which have obviously been really overstretched over the last 2 years as production decreased and demand really increased globally. The second benefit will be our major resource companies starting to see demand continue to increase for all the major resources that they sell, and that should certainly benefit them over the coming months. So what stocks are we watching as a new financial year starts? Well, the first stock that we're looking at is actually an ETF. It's called China New, and it focuses on the growth of the major Chinese companies, and I think it'll be a really interesting one with China's industrial production picking up. The second sector we're looking at really is the resource sector. Our 3 major miners, BHP, Fortescue and Rio, should all be able to produce very good profits over the next 6 to 12 months as this China story grows and demand for the product increases. And we're also expecting really good dividends from the 3 in the upcoming August results. So yields look very attractive for the resource stocks. The local banking sector has also been sold off heavily of late, as concerns around our property market have suggested that lower profits could be the norm for the banks over the next 6 to 12 months. We have a different view on this. When we look into where the sector is sitting in relation to mortgage levels, we see that the major 4 banks are all very well covered in relation to where their mortgage books sit. We're seeing less than 2% of mortgages in arrears, and in fact we're seeing many borrowers well in front, up to 2 years in front, which sees a very positive situation. The other thing that we feel is this: Australia's love of property means we think investors and property owners will fight to hold on to property rather than liquidating at prices that may not suit. So we feel that any downturn in the property market will be short-lived and maybe not as deep as many have been forecasting. For more details on the stocks we're going to be following over the next 12 months, why not speak to your advisor today?